Welcome back to the IB Hub. Today we're going to discuss how you actually construct a balance sheet. So before you actually construct a balance sheet, you need to first understand the difference between current and non-current, whether for assets or liabilities. So non-current are things that you hold for longer than a year, and for liabilities they would be an example. Let's pull it out from this question: long-term borrowing, because long-term borrowing may be in a form of a loan is more than a year, it would actually go down as non-current. For current, it would be overdrafts, because overdrafts, as you know, are short-term loans and they were paid within a year, so they'd be in current. And for assets, as a non-current asset, you'd have property, which of course property is held for longer than a year. And for current, you'd have stock, because stock is typically not held if it's a successful business, and it would actually be sold within a year. And then after you understand those concepts, you then must know the structure of a balance sheet. So we'll write it down on the side here. And the structure of a balance sheet always is non-current assets, then current assets, then current liabilities, and non-current liabilities. And then finally, equity, which is separate from those four and actually finalizes the balance sheet. So to start the balance sheet, you're going to, of course, need a title, and you must always use the title, because a lot of people lose marks actually for not writing down the titles of their balance sheets. So we'll start off with non-current assets. So of course, non-current assets are assets that you're going to hold for longer than a year, and you're going to actually need to apply it to this question. And we'll just write down non-current assets first. And then you'd actually start looking through. You can color code it if you want with a highlighter just to separate each, but I just like to go through it and just write it down instantly to have it in my mind. So first things first, we're gonna look through. So cash, trade credit, stock, and then plant. So we'll write down plant, and we'll write down the value. Because we wrote down millions at the top, you actually don't need to write down M next to it, and you can just write down the number itself. And we see that property as well, as mentioned earlier, is a long-term asset. There's also equipment. And that's it. But if you see here, you can see accumulated depreciation. So non-current assets actually suffer from depreciation. So sometimes it does come up in the table, and sometimes it doesn't, but you always have to keep an eye out for it. In this specific question, it actually is in the table, so we have to include it. So we'll just write down accumulated depreciation. And in brackets, because the business is losing money, everything in minus, instead of a minus, you'd write down in brackets. And these are all the non-current assets, and after you're done with them, you'd actually add them up. And in this case, you can use your calculator that you have with you in the test, but they'd add up to 230. So you do 100 plus 30 plus 120 minus 20. And then you move on to the next section of the balance sheet, which is the current assets. So we write a new title to separate both parts. So current assets, and then we go through the table again, similar to the non-current assets, and write them down. So firstly, we do have cash for 15. And then we have stock for 55. and we have debtors for 10, and we have just another and that's it basically for current assets. Sorry. So yes, and then we'd write total current asset, just current assets. Actually, we'll write that down after. So current assets as 80. And after you're done with the assets, because of course they are a section in themselves, you write down total assets as 310. And after you're done with assets, you move down to liabilities and your next section of the balance sheet, which is current liabilities. And let's do a double space. So current liabilities. So obviously we have the overdraft for 5. Short-term loans for 25. Trade creditors for 30. And that is it. So then you'd write down current liabilities and 60. And then move down and move on to the next section, which is non-current liabilities. And this is much easier if you were to highlight it, of course, because you'd know and you'd actually remove each option and you'd narrow it down. But for non-current liabilities, of course, you have long-term borrowing, which is 130 million. And those are actually the only non-current liabilities. So we just ended off with non-current liabilities 130. And add up the current and non-current liabilities, and 130 plus 60 would be 190. And you put total liabilities 190. And after you're done with everything, you have to add up, minus the difference between the assets and the liabilities, and write them down in a new section, which is the end of the first part of the balance sheet, which is net assets. And let's do a double space there. And of course, 310 minus 190 would be 120. Moving down, of course, this is what separates the balance sheet from other financial statements that you have on the business course. And we have equity. So equity only refers to really the shareholders and anything related to shares. So in the table, we can see that we have retained earnings and share capital. So these, of course, retained earnings are after you've handed out dividends, and share capital is what the money the business has actually gotten from selling shares. So anything that is related to really shares would go under equity. So we'd start another separate part of the balance sheet lower down, and you'd write down the retained earnings, which are 35. And then share capital, which is 85. And then those are the only two that are related to shares. So we'd add them up, and then equity would be 120. And that is the end of the balance sheet and how you construct a balance sheet. And how you know you're correct, and this actually tells you you're correct, is that the net assets